Welcome to the February monthly investment update. My name is Mathew Cassidy. We are proud to provide an update on the findings of the Royal Commission and the impact it actually has on our clients. Since commencing our business in 2003, we've been proud to say that we've always had ongoing service agreements with our clients. On that basis, we see that it's a case of continually adding value to our clients, and this is something that the Royal Commission has been addressing. We believe that the financial planning industry and the broader wealth management segment has a job to do in terms of making sure they're acting in the best interests of their clients, similarly to what we've been doing since commencing our business. Therefore, we see little or no impact as a result of the Royal Commission, and what makes us proud every day is to be making a difference to the lives of our clients.
Hello, my name is Kerry Craig, Global Market Strategist from JPMorgan Asset Management. This year, markets have started very well with a very strong return in global equity markets and in Australia. This begs the question of whether this rally can continue. For us, there are really three things that we need to see and have a strong level of conviction about for that to be the case. The first is the change in a stance from central banks here in Australia and around the world to pause on a rate tightening cycle or even to think about cutting interest rates. For us, this removes a lot of the risk of a policy error and tightening into a slowing growth environment, but also suggests they're concerned about global growth risks as well and thinking about tightening of policy unnaturally in terms of rising financial conditions. Here in Australia, that obviously links to what we think about the housing market and how much that can weigh on consumers and offsetting a bit of that constraint on household spending. Outside of Australia, it is really about the US-China trade relationship. Here we've seen mixed messages on whether a deal will be done or not, and we do think there's enough scope for them to come to some sort of agreement around the trade deficit and tariffs, effectively moving out the deadline for when any new tariffs will come into force. However, some of those other factors, such around as technology transfer or intellectual property, and the enforcement of those rules are a bit more hard to come by. And so we think this trade concern will linger in the background and a full deal might not be reached for some time. Outside of that is China's response to those measures. We see China having tried to act to stimulate its economy as it slows growth. And it has been the case that China has been acting to slow down its growth in a controlled way for some time. We've seen constraints around the leverage in the economy and the excess credit that's come through, particularly in the housing market. And now, People's Bank of China and officials are acting to offset some of that, cutting interest rates and doing more on fiscal stimulus to try and increase the amount of employment and domestic demand that's available. How much they continue to do this, we think, will really change the idea between an economy that continues to expand and one that's simply stabilised at the current level. We think any signs of stabilisation will be positive for risk sentiment around the world. Having strong conviction on those three areas will really lead to earnings to move upwards this year and think about better returns. However, they still present very big risks for the market, and so we shouldn't discount them at all over the course of this year.
Hi there, I'm Jonathan Bayes, and this is our February investment market update. And fortunately, the first 6 or 7 weeks of the year have been in stark contrast to the way we finished in 2018. The Aussie share market's up around 8% year to date and about 13% off its lows. And we've had some good news, I guess, in some respects with a bit of a rebound in US economic activity after what looked like a deterioration at the back end of 2018 on concerns that the trade rift between the US and China might not be resolved as soon as we thought. We also have had in recent weeks a pause by the US Federal Reserve, which I think is a really positive catalyst for risk assets. They've agreed to take caution on further rate hikes until they see future data coming in, which I think is again some encouraging news. We've also locally here had some less bad news, perhaps, with the Royal Commission announced last week being more benign in an outcome sense than many had forecast. And also too, I guess, with the deteriorating local economy, the Reserve Bank have come to the party and declared that perhaps the economy is more evenly balanced in terms of the likelihood of a rate rise or rate cut than they previously thought, and that's given a lot of people expectations perhaps that the next move might indeed be down. And so we've seen a rally in Australian bonds to a two-year low in terms of bond yields, and that's been really positive from an asset allocation standpoint and driving Australian shares higher. We're about to go into corporate reporting season, so fingers crossed things will come out the right way. We had Amcor numbers actually today, which have been pretty good. We should see some numbers from Challenger in a couple of weeks' time, and hopefully they won't be quite as bad as the profit warning a month ago declared it to be. But fingers crossed, our reporting season will be a good one. I would say, however, with the market as strong as it's been year to date, that I would expect to see some weakness coming through. I do think the economy is deteriorating at a far greater rate than perhaps we'd anticipated, and I don't see any respite coming ahead of the federal election in May. Thanks very much for your time.